Hi, welcome to Blueprint for Wealth. I'm Wayne Zell, your host of this fast-paced half-hour or so video cast designed to help you realize your personal dreams of wealth and freedom, featuring special guests and special topics. Blueprint for Wealth is brought to you by Zell Law, and a business, estate, tax, and fiduciary law firm located in Reston, Virginia and Savannah, Georgia, serving clients all across the U.S. If you'd like to know more about us, visit us on the web at zelllaw.com. Today, we're going to be talking with Bobby Castro, who is one of the most positive people you will ever meet. And he's co-founder of Bankers Healthcare Group and an extraordinary real estate entrepreneur. But before we get to Bobby, our special topic today is crowdfunding. And crowdfunding is something I know you want to learn more about because you want to fuel your business. So here we go. So here's an overview of what we're going to talk about today, our key takeaways. We're going to talk about what crowdfunding is, the types of crowdfunding that are available, what the securities law issues are, because they're really important and you need to know this if you're going to engage in crowdfunding, and then talk about some of the securities that are offered in crowdfunding, including the SAFE, which is a form of crowdfunding security. So what is it? It's raising money from the general public in a way that we couldn't do really before 2012. It's an alternative method for entrepreneurs, creative thinkers, and nonprofits to get funding. You can pool together small amounts of money from a group of people that share your passion or your vision and that you interact with online using a social media through an approved intermediary platform. Anyone can use it without having to go to a bank or an angel investor or a venture capitalist or a private equity fund, and the likelihood of getting funded through crowdfunding is actually higher than those other sources. The types of crowdfunding really break down into four categories: rewards, debt, equity, and donations. Rewards is where the investor gets something or some kind of perk, some kind of reward for pledging money to help you start up. It might be a t-shirt, might be a coffee cup, it might be the ability to get the first version of a product or a service that is being released. Top platforms include Kickstarter, Indiegogo, and Rocket Hub, but usually the dollars involved are very small. The debt and equity platforms are much more robust, and usually more money is being raised in those platforms. In debt, we've got peer-to-peer, P2P financing, or peer-to-business lending. The investor gives money in the form of a loan, gets a promise to be repaid plus interest, and the common platforms include Prosper, Lending Club, Funding Circle, and P2B Investor. On the equity side, the investor might get an ownership stake in the business. It might be common stock, it might be preferred stock. You might even have a mixture of debt and equity in the form of convertible securities that convert from a debt security into equity. The common platforms include Circle Up, Fundable, and Micro Ventures. And last, charities often use crowdfunding to raise money. The investor gives money for a cause they want to support. It may or may not be tax deductible. If it is, there's certain requirements that have to be met. The most common platform that I know about is GoFundMe. So who can invest? One type of investment is more informal than the other. If you are an accredited investor, you can pretty much invest not only in crowdfunding, but in other types of private placement investments, which we're not going to cover today. An accredited investor is really somebody who has at least $200,000 of income individually or $300,000 on a joint return filed with a spouse, or has a net worth of at least $1 million excluding your principal residence. Everybody else is a non-accredited investor. Before the Jobs Act of 2012, not 2021, non-accredited investors were not able to legally invest in crowdfunding. In the Jobs Act that was passed during the Obama administration, they made it so much easier. And there have been regulations released recently in 2020 and 2021 to allow for crowdfunding to be even greater and easier than ever before. There is a regulation that applies to crowdfunding that was issued by the Securities and Exchange Commission to interpret the Jobs Act of 2012. It's known as Reg Crowdfunding or Regulation Crowdfunding or Reg CF, abbreviated. It provides an exemption from having to register the securities with the Securities and Exchange Commission on a federal level. It allows for small individual investments, and it allows for contributions from a large number of small investors. The maximum offering that can be made under the federal law in a crowdfunding offering during a 12-month period is $5 million. Up until last year, it was only $1,070,000. The regulations increased the threshold, and that is a huge positive change for people who want to use crowdfunding. Reg CF continued. It has investment limitations on what an investor can invest and how much they can invest over this time period. Basically, for a non-accredited investor, if the investor's annual income, so their compensation income, their dividend income, or their net worth is less than $107,000, then the investment limit is the greater of $2,200 or 5% of the individual's income or net worth, whichever is greater. Again, there's a limitation on the amount that an investor can invest in one crowdfunding deal. If the non-accredited investor's annual income or net worth are greater than $107,000 or at least equal to $107,000, then the investor's limit is 10% of the greater of the income or the net worth. But again, cannot exceed $107,000. So this 5% limit is sort of where you start out. It can increase if your income is greater or your net worth is greater than $107,000, but you're limited to 10% of the greater of your income or your net worth, capped at $107,000. There's no limit on the number of investors or the minimum amount that can be invested in one of these deals. The regulations that were issued by the SEC as recently revised were very favorable, are very favorable in terms of how you go about advertising and raising money. You can only advertise by offering a notice that directs investors to one of these intermediary platforms like Fundable or another registered broker-dealer who has been approved by the Securities Exchange Commission as an approved funding portal. And it cannot include any more information in the notice than what the SEC rules allow. You have to file Form C with the Securities and Exchange Commission, and in some states you may also have to file the Form C. Oral communications with prospective investors are permitted, which wasn't allowed before, once you file the Form C. And when you look at the Form C online, you can go to sec.gov and see it. It's really not that hard to complete. So this is a great opportunity to do roadshows. Once you've submitted the Form C, to go out and seek investment from small amounts from investors who are non-accredited, or there is no limitation on the amount an accredited investor can invest in a crowdfunding deal, except that the crowdfunding is capped at $5 million total. Remember that, in a 12-month period. The terms of the offering and the Form C have this information that you have to provide: the amount of securities offered, the nature of the security. Is it common stock, preferred stock, convertible debt? Is it a safe security, which we'll talk about in a second? How much the security costs per unit, per share. When's the closing date? When is the 12-month period? When does it expire? And it is a very definitive period that must be limited to 12 months. How are you going to use the proceeds? And what is your progress in meeting your funding target? You're allowed to test the waters now. The amendments that were made to Reg CF recently allow you, if you're raising money, to test the waters or solicit interest in a potential offering from the general public orally or in writing prior to filing a Form C. Now, this is different from advertising, okay? Testing the waters have to have certain legends attached to the disclosure that's going out. You have to include the Form C, ultimately, when you go out and test the waters. And once you file the Form C, any offering communications have to comply with the regulation going forward, particularly the advertising registration rules. Blue sky. If you want to sell securities in your state, the state may limit your ability to do crowdfunding if you don't qualify under Reg CF. I'm repeating this. So Reg CF is designed to preempt all of the states in terms of crowdfunding, so that if you comply with Reg CF, file the Form C, give all the information that is required under the regulation, comply with the advertising rules, and so on, then you can go ahead and sell interstate your securities over the internet using these approved platforms. Virginia, for example, has its own intrastate crowdfunding exemption, which means that the entity generally either has to be performed under Virginia law or do most of its business in Virginia, and it can only sell to Virginia investors. And the limitation is lower, and the amount that can be invested is much lower, as you can see from this slide. The bottom line is Reg CF preempts state law registration requirements and exemption requirements. And so while Virginia has this intrastate rule, if you comply with Reg CF, you don't have to comply with the Virginia rule because it's preempted. Same thing with Maryland's rule. We are in this local area. I thought it would be useful to put up the Maryland intrastate crowdfunding exemption. And the intrastate crowdfunding exemption specifically says that you can convert an intrastate offering into an interstate offering as long as you modify your materials and comply with Reg CF. So again, the rules for intrastate crowdfunding exist in 30 states and the District of Columbia. But if you don't comply with the state regulation, you can still comply with the federal regulation and sell interstate. So that's pretty cool. A word about SAFEs. A SAFE is an agreement between you as an investor and the company in which you want to invest, and the company promises to give you some type of future equity stake if certain events occur. Not all SAFEs are the same, first of all, number one. Number two, there are important terms that you need to be aware of. And number three, SAFEs are not simple or safe all the time. What's important to remember? You're not getting an equity stake when you put money into a SAFE with a company. It's not common stock, it's not preferred stock, it's not any form of debt, unless the SAFE says that it will be repaid under certain circumstances. And so you can't get your equity stake that you thought you were going to get unless the triggering events have occurred. The terms of the SAFE have been met. Triggering events might be when our company is acquired by another company or merged into another company, which may be far down the road. Or it might be an IPO. Or it might be merging with a SPAC, a special purpose entity that is already publicly traded. Or it might require that you achieve a certain level of equity investment in the company and that they offer an additional round of financing where it allows you to convert the SAFE into that equity financing. There are a lot of things to consider about SAFEs, and they're not necessarily safe. Again, it may trigger a conversion into common stock if the triggering event occurs. But let's say the company goes out and offers preferred stock, and the SAFE is geared towards raising money in the form of common stock. Because they raised money to sell preferred stock and not common stock, your SAFE still stays in this form of an agreement that might be converted or might not be converted in the future. And that means you may lose your investment if they never issue the common stock after the SAFE has been given to you. Convertible notes are a common alternative to SAFEs, meaning that you give money to the company promises to pay you back some level of principal plus interest. But if they raise a certain level of financing or they go public, the convertible debt might automatically convert into common stock at some form of exchange ratio. The conversion terms are really important. You have to look to see whether or not there's a repurchase provision so that it allows the company to repurchase your right to convert into equity instead of being converted into equity so that you can get your money back. You've got to know what happens to your money if the company dissolves or liquidates. Are you just a general creditor lining up behind everybody else to get your money back? Are you even a creditor? And do you have any voting rights associated with your SAFE? That is a word on SAFEs, and that is an important consideration when you're trying to do crowdfunding. So you can do a SAFE, you can invest in a company through a SAFE, but be careful when you're issuing securities that are in the form of a SAFE. So we've been talking about crowdfunding, and I appreciate the opportunity to tell you about it. But now you're going to get the opportunity to hear from one of the most extraordinary entrepreneurs in the United States, a man who's taken a company with his brother and another partner from zero to over $1 billion. And they did it through their sheer will and tenacity and positive mental attitude, which Bobby Castro is going to be our next guest, telling you about the secrets of his success, not only in building BHG, but also in being a real estate entrepreneur. Stay tuned.